trust fund could either save you thousands in taxes or cost you 37% of your income if you don't know the rules. One wrong move, and your trust could turn into a tax nightmare. Let's discover how to protect your wealth and avoid the costly mistakes most people make with trust funds and tax returns. A trust fund is a legal arrangement where one person or entity holds and manages assets on behalf of another. It's often used to protect and transfer wealth, ensuring it's managed and distributed according to specific rules. The person who creates the trust is known as the settlor or grantor. This person transfers assets like money, property, or investments into the trust. Next, there's the trustee, who is responsible for managing those assets. They follow the rules set out in the trust document. Finally, the beneficiary is the person or group meant to benefit from the trust. They'll eventually receive income or assets according to the trust's terms. In many places, a trust isn't considered a separate legal entity. It's more of a relationship between the settlor, the trustee, and the beneficiary, with specific rules on how and when the assets are handled. Next, let's explore the different types of trusts and how they affect your taxes. What are the types of trusts, and how do they relate to taxes? There are two main types of trusts when it comes to taxes: revocable and irrevocable. A revocable trust is flexible. The person who creates it, known as the settlor, can make changes or even cancel the trust entirely. This flexibility means that the assets in the trust are still considered part of the settlor's estate. For tax purposes, any income generated by those assets, like rental income or interest, gets reported on the settlor's personal income tax return. So there's no separate tax filing for the trust, and it doesn't change how much tax the settlor pays. The trust is more about managing assets rather than getting any tax breaks. An irrevocable trust, on the other hand, is locked in once it's set up. The assets placed in it can't be taken back or easily altered by the settlor. Because of this, those assets are no longer considered part of the settlor's estate. This can help with estate tax planning or protecting assets from certain claims, like nursing home costs. However, when it comes to taxes, things can vary. Sometimes the income from the trust is taxed at the trust level, and other times it's passed on to the beneficiaries. It depends on how the trust is structured and how the income is managed. So, the key difference between these two types of trusts is control and how taxes apply based on who holds that control. Now that we've covered the types, let's break down the basic principles of how trusts are taxed. Taxation of trusts, basic principles. When it comes to taxing trusts, two key elements are involved: trust income and capital gains. Trust income is any earnings from the assets inside the trust, like rental income, dividends, or interest. How this income is taxed depends on whether it stays in the trust or is given to the beneficiaries. If the income is kept within the trust, it's usually taxed at the trust level, and trust tax rates can be steep. In the US, for example, trust income that exceeds $13,050 gets hit with a 37% tax rate. But if the income is distributed to beneficiaries, they're responsible for reporting it on their personal tax returns and paying the tax at their own rates, which could be lower. Capital gains, on the other hand, come from selling trust assets like stocks or property for more than their original value. These gains can either stay in the trust and be taxed there or flow through to the beneficiaries. If the gains stay in the trust, the same high tax rates apply. Many people have misconceptions about how trusts are taxed. Let's clear those up next. There's a common myth that all trusts get taxed at ridiculously high rates, like the 37% tax on trust income above a certain amount. This idea scares a lot of people off from creating trusts, but it's not the full picture. Most grantor trusts, like revocable living trusts, don't even have separate tax filings. Income from these trusts flows straight to the settlor's personal income tax return, just as if the assets were never placed in a trust. So, there's no additional tax burden. Everything works the same as it would if the settlor held the assets directly. No need to worry about that 37% rate here. The confusion often comes from financial advisors or brochures that oversimplify trust taxation. They see the high tax rate applied to non-grantor trusts, where the income stays in the trust and is taxed at the trust level. This leads many to believe that all trusts are a tax nightmare. But that's simply not true for most common trusts, especially those designed for estate planning purposes. Before deciding against setting up a trust, it's important to ask the right questions and understand how your specific trust would be taxed. This avoids unnecessary stress and keeps your financial plan on track. So how does trust income get reported on tax returns? When it comes to reporting trust income on your tax returns, it depends on the type of trust. For grantor trusts, like revocable living trusts, the income is treated as if the settlor still owns the assets. That means the income, whether from investments, property, or interest, gets reported directly on the settlor's personal tax return. In this case, the trust doesn't need to file a separate tax return, and everything is handled as part of the settlor's usual taxes. For other types of trusts, like irrevocable trusts, things get a bit different. If the trust generates income and keeps it within the trustee has to file a separate tax return for the trust using IRS Form 1041. This form is used to report any income the trust earns. If the trust distributes income to its beneficiaries, that's when Schedule K1 comes into play. Each beneficiary gets a K1, which shows how much income they received from the trust. The beneficiaries then use that information to report the income on their individual tax returns. This way, the trust itself doesn't pay tax on the distributed income. It's the beneficiaries who are responsible for paying taxes based on their personal tax rates. Finally, let's discuss the benefits, potential pitfalls, and when it makes sense to set up a trust. Here are some of the trust benefits, pitfalls, and when to consider one. Trusts offer several advantages, starting with asset protection. Assets in a trust can be shielded from lawsuits or creditors, giving you more control over what happens to your wealth. Trusts are also great for multi-generational wealth transfer, ensuring that your assets are passed down smoothly to future generations. In certain countries, setting up a trust can also bring tax benefits, depending on local laws, which may reduce estate or income taxes. However, there are potential pitfalls to be aware of. Trusts that retain income often face high taxation, where income above a certain threshold can be taxed at 37%. Another challenge is the gift tax when transferring assets into a trust, which can be confusing. For those dealing with international trusts, navigating different tax rules across borders can lead to double taxation or unexpected complications, making professional advice crucial. When should you consider setting up a trust? If wealth preservation is important, a trust can protect your assets and manage them over time. Trusts are also helpful if you're planning for incapacity or want a clear structure for transferring assets after your death. Additionally, a trust can help shield assets from estate taxes or other claims. Trusts aren't just for the ultra-wealthy. They're useful for anyone looking to streamline estate planning and protect what they've built for the future. If you've ever considered setting up a trust, let us know in the comments. What's your biggest concern or question about the process? Make sure to like, share, and subscribe, and hit the notification bell so you don't miss out on more useful tips.